Brad Donnelly.
Brad Donnelly.
Back again.
The first guest that we've had on as a repeat guest.
Yes.
That's cool.
That quick, within a month, too.
Wow. Well,
You must be chock full of knowledge, and we got some good stuff to talk about
Well,
today.
I think the last time we actually, like, we all spoke, like, we've learned a little, like, Brad was like, there's so much more we could talk about.
Yeah.
And we got really into the depth of, like, a lot of things. But today we're going to try to make things a little bit more simple and break it down a little bit. Brad's just full of knowledge over there, just itching to get it out. So let's go.
So the way that we're going to go about this today is we're going to go from the beginning of the buying process to the end from your point of view, from your financial broker point of view, to getting the mortgage, to getting approved. And as we go through that, so the goal for anybody watching will be that they have a better understanding of the process, of the entire process from start to finish. And then as we go through this, we're going to go off on little tangents on things like credit score, down payments, and then, but we're going to do the full circle and bring it right back to the buying process and end with the pretty well somebody getting the mortgage and getting everything sorted out from there. So I think without further ado,
this will help a lot of people, because if everyone does what we're going to talk about, it makes life easier for everyone.
Right.
Everyone. You, me, everybody.
Yeah.
So let's go.
So let's say somebody's coming in, Brad. The first thing that they're coming to you, they say, I want to get pre-approved. That's the first step that people should be looking to pursue in the home buying journey. So somebody comes to you, Brad, and they say, I'm looking to get pre-approved. What's your steps at that point?
so when we're doing a pre-approval, we're basically pre-underwriting the file. So we need to get as much information as possible up front. So we're trying to gather as much as we can. So when a client calls or we have a meeting, the first thing we're going to ask for is all the information about your income. I'll break that down, your debt, and your history. So if you go through an application process, like we have a software package like everybody else does, and the first thing we're going to look for is we're going to, what's your name, what's your address, what's your 3-year history of your address? Because, again, lenders require all of this because any file could be audited by OFSI. So we have to, which is the Office of Superintendent of Insurances, so which is a part of the federal government. So at the end of the day, we have to kind of gather as much information. So we're really kind of honing in on, okay, so where have you lived for the last 3 years? Give me the last 3 years of your job history or your income history. You might be retired, you might be getting CPP and OAS, or you might be working, or you may have changed jobs. So we want to get a good grasp of what your income is, where it's coming from, who's on it. Are you receiving child tax benefit? That's income money we can use. Are you receiving maybe investment dividends? That's money we can use. Obviously your paycheck, or if you're seasonal, maybe you're a fisherman or you're working in the woods and you're seasonal. Every year for the last 2 years, you've gotten T4s and you've gotten EI. That's fine.
For seasonal workers, is there certain banks that won't touch that?
I think most banks, most brokers will use seasonal as long as it's 2 years or more. So it's much like being self-employed. If you're self-employed, we want to see 2 years. We want to see the pattern.
Right.
Yeah.
Okay.
So we're looking for your income. Then in the conversation, we talk about your debt, and we get a rough idea of what your debt is. Like, what are you carrying for credit cards? What's your car payment? That's a killer always, because large car payment means you're using up a lot of your income for car. So what, credit cards, car payment, student loan, those type of things. So that's the income, the debt, and then we will send you documents for you to sign so that we can pull your credit to confirm, on the credit report, what you said is real. Is that being reported properly on the credit report? Because the lender is going to look at a credit report.
Right.
We'll also ask the client to send us all their income documents. So we're looking for 2 years T4s. We're looking for your notice of assessment, child tax benefit if you have it, and if you're retired, your CPP statement or your old age security statement. The reason we ask for the T4s is to confirm what you're bringing in for income and what you have brought in for income in the last 2 years. We'll also ask for eventually, not up front, but eventually a letter of employment. And in some cases, your letter of employment is either going to be better or worse than your T4. So, for example, if you're working at Southern New Brunswick Railway and your base salary is $75,000 a year, but you work a ton of overtime, we as brokers can opt to use your 2 years T4s with your overtime as opposed to your letter that says you only make 75.
Okay.
So if you worked overtime and you made $98,000 or $100,000 a year, and then the second year you brought in 101 or 102, we'll use the 2-year average as opposed to your job letter, which gives you an opportunity to get more house.
Okay.
Right.
So that's why we ask for T4s. Why do we ask for notice of assessments? We want to know that you don't owe the taxman any money. Because, little known fact, the taxman takes first payer status on any house. So, if your house went into receivership or default, the lender's not going to get the house first. Canada Revenue is going to put a lien on the house first.
Okay.
Yeah, so the government always wins in that situation.
How recent do the taxes have to be paid for anybody like out there? Let's say if they owe some back taxes, or if they're behind a few years. What is a like? Do all taxes have to be paid up to date in order to get approved for a mortgage?
Yes.
Okay.
Short answer is yes. Now, if you have a tax, say you did your notice of assessment last year and you owed $1,200, we would ask the client to pay the CRA debt, the $1,200, and give us a statement showing they have a zero balance before the house closes. Not at time of application, but before the house closes. So it gives the client time to kind of pay that off.
Right.
Okay.
So if you owed whatever, say you owed a little bit, could you use say you're taking money at RSPs or something like that for your down payment? Could you say the down payment was $18,000, but you had $30,000 RSPs? Because I think you can take out up to $30,000. 35,000. So could you use that RSP money extra to pay off any taxes owing?
That is going to be dependent on the lender. Some lenders will allow you to do it. Some lenders probably won't. It's always safe to say if you're going to pay off Canada Revenue debt, I know most of our what we call A lenders, our top of the line lenders, will probably say no. It should come out of your own account. The RSP is intended, the first-time homebuyers plan is intended for down payment, closing costs, moving costs, whatever you think is necessary to withdraw from your RSP to enable you to get your house.
Okay.
Right? That's the intent. So how you shuffle your money is really up to you, but at the end of the day, if you're going to take $20,000 out to cover your down payment, your closing costs, the cost of your move, maybe the cost of a hotel while you're waiting to move in, that type of thing.
How do you, for people that, I have clients now, they have, say, credit card debt and this, how do you recommend, how do people save for a down payment today with all the world? It's so expensive, to live here. How do you recommend any tips to?
Well, I mean, the hardest thing to gather is the down payment. So the minimum down payment on a single family home is 5%. So how do you get that? Well, you can take it. But most people that are working 9 to 5 in an office will have an RSP plan with their office. If your company offers you that RSP plan, take it because they're taking the money out of you before taxes. So that money's sitting there; it's not taxed, right? That RSP money is sitting there, and you can take it out through the first-time homebuyers program through the RSP. Tax-free as long as you repay it over 15 years.
Right.
So that's
repay
one
what,
option.
the taxes or the money you borrowed?
It's like you have to put the RSP back in there kind of deal.
So
right?
if you took $20,000 out of your RSP tax-free and you used it, you have to repay that $20,000 over 15 years through your regular annual tax return.
Oh, your accountant just kind of takes
it. Yeah,
Yeah.
Basically, they just take 1/15 and they add it to your taxable income. And the way to counteract that so you don't lose any money at tax time is just to have your employer take an extra $20 out of your paycheck every 2 weeks. That way, it'll be like nothing ever happened.
That's smart.
So it's all tax-free, it's all interest-free. So the RSP plan is a great plan as long as you understand that you've got to pay it back. Now, there's a second option, which is if you'd want to open up an FHSA, which is a first-time homebuyer savings account, which is new as of last year. So that enables you to say, it's like a savings account. Any bank will open it up for you. It's a savings account. So you can take maybe $100 a week and throw it in there, $100 a month, whatever you can afford, and throw it into your FHSA. So the first-time homebuyer savings plan is basically it's a bank account that allows you to withdraw the money from the FHSA for your down payment.
Is there interest in that account? Like, can you accumulate interest on
It
your
does,
money?
yeah. You can accumulate interest in the FHSA. It's a bank, so you're not going to make a lot of interest on it.
Right.
But at the end of the day, you can take that money out and apply it to your down payment. And then next year, that's a taxable benefit. That $8,000 you're allowed to put in your FHSA every year is an $8,000 credit on your tax return next year.
Wow.
So it's a huge.
If you don't use it.
No, if you use it. Like, if you withdraw, if you've opened up an account and you have the amount of money you have in that FHSA, as soon as you withdraw it, it triggers a tax benefit for next year. You'll get a receipt.
Now that money that you have in the FHSA, that already has been taxed though, right? That's already taxed money?
That's after tax money, right?
After tax money.
Because you're contributing from your income.
Oh,
Right.
so it's okay.
Right.
So you've already paid
been-
income tax on
Yeah.
it, and then you put that into an account.
Yeah.
And then there's a taxable.
There's no tax involved.
No, okay, but
No.
so the credit that you're talking about, I'm just trying to wrap my head around
The
that.
credit, yeah, it creates a credit.
It creates the credit.
It creates a credit
Okay.
on your next year's tax
So
return.
it's like $8,000 of income you didn't receive then.
That's right.
Okay. Okay.
Yeah.
Cool.
And there's no 90-day limit. You can open it tomorrow and take it out on Tuesday. And as long as that money, if you transferred it from your checking account into your FHSA today, and then 5 days later you decided to withdraw that money,
Yeah.
it's no prerequisite to keep it in an account.
Now,
for
do you
90
have
days.
to use that for, say something comes up, you just don't end up buying a house and you're saving in that for 2 years, can you take it anyway? Or do you have to use it for a house?
No, you can take it out. You just
have
won't,
access to
you
it,
just won't
yeah.
get the credit for it.
Right.
Okay. Okay. So in that, that there is kind of the opening statement of the first steps somebody should take when they're looking to get into purchasing a home. So we just talked about kind of like the pre-approval process, but in there was a whole bunch of things that I wanted to unpack as well, because we were talking about like credit score and making sure that you have your down payment and everything along those lines.
Yep.
So I think it'd be a good idea to maybe steer this in the direction of, for people watching, what's considered good credit? What do you look at as good credit?
What's the minimum credit you could have today
Right,
to even
like-
get considered to buy a house?
Well,
Thank you.
2 years credit, 2 lines of credit. So it's either 2 credit cards or a credit card and a car loan, or a credit card and a line of credit. 2 credit lines for 2 years. That's kind of the minimum.
Two credit, I don't know.
2 credit lines for 2 years?
Yeah.
What do you mean?
So when we say credit line, a credit line can be a credit card, can be a line of credit,
Oh, I see.
can be a car payment, can be a loan. So 2 units of credit for 2 years.
In good standing.
In good standing.
Now,
with
right. So what's considered good standing? Like, what do we look
payments
at?
made on time.
Payments made on time, always.
Always.
Let's say there was 1 month for some reason.
If you have a reason and it's 1 month, you have a reason and maybe it's 2 months over 24 months, then usually the lenders will be okay with it. But
Okay.
you've got to have a good reason, because we have to explain that to the lender.
Right.
Right.
Well, you know what's something that threw me off when I was first learning about kind of like credit cards and stuff like that is the payments. So I used to set my credit cards up on renewed payments at a certain date every month. I was like on the 27th for whatever reason. Like, I'm just throwing a number out there, but I always was like on the 27th, I'm going to pay the card, and that way I'm paying it monthly. What I didn't realize is that these credit card cycles move. So their monthly payments are due at different times each month. It's like every
What?
like 20,
Really?
20 some days. Yeah, I didn't know that because I started to fall out of cycle, and then I was getting calls saying you're late on your payments, and I'm like, I pay at the same time every single month, and they're like, well, right, if you do that, you'll eventually fall out of cycle. And I was just like, they make this really challenging. They make this really.
I did not
and then
know
I just
that.
put everything on auto pay on my online banking. I
can
put it
do
all
that?
on. Yeah, you
Auto
can just
pay
put
for
it,
a credit card?
Yeah, you have it on like the minimum payment at least comes out, so that if you're paying at the wrong time, then you don't get any negative hits
Okay.
on your credit card.
Yeah.
But so that was kind of like one piece of advice that the bank gave me, but they do make that fairly tricky. So that's the reason I was asking about that too, because like
Yeah, 'cause
sometimes
it will
making those
happen.
payments
Sometimes
on time. Yeah.
something will happen and it'll fall through the cracks.
What is the minimum score? Like Brandon was saying there. What? I don't even know. Is it 600 or 700? Like, what do you
Every
need?
bank, every lender is different. Every broker.
Like,
a
I'm
broker
talking
lender.
a good lender, not B. Like for if you're
If I were to say that
To get the best interest
Yeah,
rate kind
yes.
of deal. To get the best interest rates,
it's not that that's
the
usually
most
not-
favorable.
You will always get the same interest rate as long as you meet the minimum beacon score, the minimum credit score.
which
Right.
is
Which is
On
exactly.
average, because it's different from every lender. We deal with 32 different lenders.
right.
Right. So it's
Yes.
different for every lender.
Okay.
They range from 610 to 660. I'd say if you have a
610
credit
to 660?
as a minimum. So I
Okay.
would say 650. If you have a 650 beacon score, that's what you need to have. A beacon score is a credit score. Yeah.
Like the way they have it set up, though, I don't like. If you get your credit score checked, that drops your credit.
So
Yeah.
It's so foolish. Like, what? Sorry, I
Right.
checked my credit score.
So the
Now
more you
it's
check-
down.
And, well, that's the difference between, and I'm not super familiar, but there's soft credit checks and hard credit checks, right?
So let's talk a little bit about that. So
Let's
your-
talk on it.
Your,
Let's
your
do it.
credit check is a check of your credit history, your credit capability, your utilization of how much of your credit you're using. A hard hit is when a lender, you have to have a hard hit done whenever you're borrowing a vehicle or buying a vehicle, whether you're leasing a vehicle, whether you're purchasing a property. That's called a hard hit. And yes, your score does go down for 30 days. It will bounce back. So keep that in mind. It
Wonder
will bounce
why,
back.
though?
The reason is simply that if you have somebody that's out there searching, or what we call troll in the industry, trolling for credit, going to every lender. So I have had clients that have gone to 5 different banks and brokers. Five hard hits. Boom, 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 boom.
Without
So their
knowing.
score has gone from 700 to 620
Yeah.
Oh,
because they're trolling for credit. They're looking
not
for credit.
knowing, probably.
Probably not knowing because maybe their banker or broker didn't tell them, which is the first thing we tell people. We don't hit your credit until we really believe that you're going to buy a house. So at the end of the day, we hit their credit. So there's a little known fact about brokers is that brokers will hit your credit once. Okay. The banks will then do a soft hit to confirm your credit report.
Okay.
So you might see on your credit report, Brad Donnelly Mortgages or Premier Mortgage Center, hard hit. And then you might see TD, Scotia, First National, Manulife on there. Those are all soft hits. They don't affect your credit.
They don't affect it?
Don't affect it at all.
Okay, but you'll see multiple banks trying?
You'll see it, but it'll be coded as a soft
But with
hit.
the soft hit, can
Okay,
you
okay.
tell, like, okay, this person's going to be good? Or, like, sometimes, like, can you really get into the the nitty gritty
Oh, yeah, we
of
get-
their stuff with a soft credit? Does that make sense?
With a soft hit,
Yeah.
you'll get the
'Cause-
same information, but it won't be as detailed.
Okay.
A hard hit will give you the complete entire credit history of a client.
Okay, so there is different information pulled on either of these hits.
Yeah.
So a soft hit is less information than a hard hit.
Yeah.
That's interesting. I did not
So
know
a hard hit, we do the hard hit. The bank just does a soft hit to confirm that the credit report we pulled is authentic.
So you do
Okay.
okay, because you're dealing with the bank. So you do a soft hit before you
that. No,
actually
he does
send
the
it.
hard hit.
I do a hard hit first.
He does the hard
then-
hit, and then
okay.
and then whatever bank he sends people to, it sounds like they confirm it with a soft hit on their end. Now,
gotcha.
what I'm not
Okay.
sure of on what you said there, Brad,
Yeah.
and I'd just like to break it down a little bit. So you mentioned multiple banks
Yeah.
saying that Scotia, TD, RBC will all do soft hits. Are they all doing that, or is it just one bank normally checking that you're?
So if I
Are you
take
normally
if-
checking on multiple banks, or is there only one bank normally doing the soft hit?
Well, it depends on the client too.
Okay.
So the client may say, well, we want to work with First National. So we will send the application to First National. They will do a soft hit on it. Or like a client that we dealt with before, where the First National didn't have the appetite for the client. They felt that the client, wasn't to their liking. So we had to take it to another lender. And so that second lender did another soft hit.
Okay.
And that client is now closing their house very soon.
Interesting.
So to wrap that portion up, so we said the credit score needs to be around. You said between 610 and 650 is a minimum.
Minimum, I would say if you are out house hunting in this economic time,
Yes.
650 should be your benchmark.
Okay.
Or
fair.
more.
Or more.
And that
Right.
goes
That's
from
what
six-
most of the people are going to want to know.
Yeah.
That's it. Forget the rest. What's
Now-
my credit score going to be?
Right.
If you're a
Right.
secondary person on an application, so if it's a husband and wife and the husband is the breadwinner,
Yeah.
his minimum credit really should be 650 or more.
Okay.
And if it's 650, it just basically means that they haven't had a lot of time to build credit or they had stumbled in the past, usually. The average credit score from the average client that we see come across our desk is a 680 or above.
Okay.
Now, yes, we do get outliers. We get, secondary people that might have gone through a bankruptcy 7 or 8 years ago, might have had some issues. Maybe they're separated, that type of thing. But to go back to the second person on the application. So if Evan has a 680 beacon score and Evan's spouse has a 620 beacon score, because Evan is the breadwinner in the situation. That secondary person, we can still use their income. It's not going to hurt the deal as long as it's over, say, 620, 630.
So if the primary breadwinner has
to have a higher
So
score.
sometimes it's
score
not where
has to have
vice versa. Like if my wife, Brandon's girlfriend, had a better credit score than us, say, and ours wasn't the best, sometimes it might be better for either of us not to even be on it.
There are some cases where it's better to not have the spouse on it. Yeah, absolutely.
Okay.
And usually the breadwinner is the one with the lowest credit score because they're using up the most amount of credit. They're the ones that are, the breadwinners are usually the ones that are, getting the credit cards on the line of credits to be able to, facilitate living in a rental property or in a house that they're living in right now.
Right.
It's a secondary person who may have a part-time job or may have a smaller job or a job that may not make as much as the breadwinner that is going to have a higher credit score because they're not utilizing the credit. So
Right.
it's kind of a catch.
So then in that situation, do you need the breadwinner involved in purchasing and getting on the mortgage because they make the majority of the money, even though the spouse has the better credit score? Like in that situation, what would you recommend? Do both of them probably need to be on it?
I would tell you this. Everybody's situation is as unique as your DNA.
Right. Yeah.
So there are things and there are little things in your credit that we have to look out for and little things in your spouse's credit that we have to look out for. And it really depends on the dynamic. How long you've been married? Do you have kids? Are you separating? Are you divorced? Are you, so everybody's situation. How long have you been working there? Did you change jobs recently?
And let me ask you this.
Yeah.
In this, you must have say there's a couple that've been together for a while,
okay,
and then you go to do the credit score. You must have to have some pretty awkward conversations sometimes.
Absolutely.
If you know what I mean. Like,
so
there's some secrets that people
Right.
gotta bring up that don't even know what's going. Like, why is this? What do you got? Like,
and this is why I say you should use a broker.
Yeah.
A broker is a licensed authority, a licensed financial officer.
Marriage counselor.
Yeah. Well, yeah.
So are we.
So we are licensed. We are licensed through FCNB. So we have a fiduciary duty, much like talking to a doctor or a lawyer.
Yes.
Same with us. Yeah.
Any conversation that you as a client have with me is absolutely 100% protected by law.
Right.
It cannot be shared with anybody, including the lender, unless it's required to get the application through. Right. We do have clients that send us 100 pages of documents. We will only send the documents that the lender requires to close the deal.
Smart. Yeah, that makes sense.
And we do have situations that are very, very challenging. The worst thing is to call a client on a Friday afternoon and say, "I'm sorry, your credit's not where it should be. We cannot finance a house." That's the worst, absolute worst part of our job.
Right. Yeah.
The best part of our job is telling that young couple that
they're approved,
that they've got their first house.
Of course.
And then you have those conversations with couples that are, say, separating. So we have a situation where I'm dealing with the wife, and my business partner is dealing with the husband. So we have to keep that separate too. Right. So I can't talk to my business partner about that part of it, and he can't talk to me about her part of it. So we have to have those difficult discussions individually.
Yeah, that could get awkward.
So in that process, we're still at the pre-approval process, really.
Yep.
So so we talked about the credit score, what's required. Let's touch on income at this point. So one thing that we wanted to touch on here is what is considered income, and I know you kind of grazed over it, but let's kind of go into the depths of that. What can people use as income, and what's something that you guys qualify as income? And I know that it'll be different at certain banks that you go to too, if I'm not mistaken.
Mm-hmm. A little bit, yeah. So everything. If it's an insured deal, in other words, if you have CMHC insurance, if it's an uninsured deal, there's always two different versions of everything.
Okay.
So let's assume somebody's buying a house, and then let's talk about the different types of income. If you're full-time, great. You are either paid a salary or you're paid an hourly wage. If you are full-time and you're getting paid a salary, we can either use the salary or your T4 income for the last 2 years, whichever's more.
Right.
If you're hourly, we have to, because you're paid hourly, use the 2-year average of your T4s.
Okay.
What if there's, say you're a waiter, bartender, whatever.
Mm-hmm.
They actually make pretty good money. They have to claim a certain percentage of their tips, correct?
Yep.
So what if, they make, say, $15 an hour, but they make really like $30 an hour with tips. Whatever's claimed over 2 years, can you guys use that for
Yes.
a bartender or waiter? Just like
Yes.
I don't know, I just thought of that because
Whatever's
there's a
claimed, right?
Yes.
yeah,
Absolutely.
whatever's claimed. So the
So-
more tips they like, anyway, the more
Yeah.
tips they claim, the better actually they are for. Because usually they're pretty consistent with what they make on a weekend or
Right.
at.
So
right?
if you're a waiter or a bartender, you're making X amount of dollars, you're getting a T4 from your employer at the end of the year. That's your income. But on your tax return, you're claiming tips. So your notice of assessment is going to be different because you've claimed everything on your on your taxes.
So that records as you can
Right.
show your NOA to you, and then that would
NOA
show.
and your tax return. You'll need to send me your tax return for the last 2 years so
Okay.
we can show where that money came from.
Okay. Yeah.
Right. So if you're declaring $50,000 as a waiter or a bartender, we need to know where that money came from.
Right.
So we will need a copy of your tax return for the last 2 years.
Right,
So
okay.
that's another caveat to the income portion.
Because I
of it.
know there's a lot of bartenders, waiters that make really good money, right?
Sure. Oh yeah.
Absolutely.
Right?
Absolutely. Yeah.
really good.
And most of it comes from the tips.
right. Oh, that's
Right?
right. Yeah, that's what
Yeah.
they're there.
Yeah. So that's
And then
that.
there's the catch-22 of claiming
claimings.
all of it, and then
Yeah.
you pay the taxes on it. But it's really good. See, that's the thing too with like business owners as well too, right? And that's something I wanted to kind
I'd
of
claim it.
get into when it comes to income is like business owners and people like, I mean, similar to us, right? Like running our own business.
So self-employed income, and I am self-employed. You are self-employed, right? So commissionable income. So again, it depends if you're incorporated or you're not incorporated. What do we require, right?
Yeah.
So definitely, it's a minimum 2-year history. So that's 2 years of tax returns. So we're looking at from a self-employed person, we'd be looking for, if you are purely self-employed, you're not an employee of your brokerage. We're looking at 2 years T1 tax returns. We're looking at 2 years notice of assessments. And that's basically it. And they may ask for a history of your closings.
Right.
So, like, I think this day and age, their cat.
It's all good.
This day and age, a lot of people are, I think, the younger generation are starting to maybe go towards entrepreneurship a little bit more, work for themselves. I just think times are changing a little bit. So let me ask you this. You might not know the answer. I'm not sure. But if I'm, like, me and Brandon, we've been incorporated just over 2 years now, right?
Mm-hmm.
When can we start buying stuff with the company? It's 2 years type thing? Or for anyone out there that's listening that has, they should get incorporated if they're not, if they're working for themselves type thing.
Is that a question or a
Yeah.
statement?
Question, should they? I read.
There is a certain point when it's better.
I was trying to ask something there, but I couldn't really put it in words.
There
I
is-
really didn't know, but do you know what? Like,
there's a certain amount of income you should be making in order to be incorporated. In other words,
because if you're a sole proprietor,
Yes.
like say you're mowing lawns for 2 years and that's your company, you're mowing lawns in the summer, snow blowing in the winter, whatever. Like, if you don't incorporate, then you really don't have a job type thing, right? You're not working for anybody.
Doesn't matter.
Doesn't matter.
Doesn't matter.
Like you're talking about sole proprietor?
Yeah, like doesn't matter for people to.
Well, I know, like,
If
and
that's
I think,
what your
and I think
job
what
is, and
you're
you're declaring the money. If that's what your job is, and you're
As
declaring the
long
money,
as you're
you don't have to be
declaring it,
incorporated.
you're good.
Yes, as
You
long as you're
build up
declaring it. Right.
And I think what you're saying is it can be easier for banks to look at you when you're incorporated and paying yourself as an employee in your company.
That's what I'm.
That's what you're kind of alluding to, right?
Is
like,
it?
Pretty well saying.
No.
Is it not? So I always was under the impression that it's better if you have a corporation, pay yourself regularly, let's say every 2 weeks from your company, so that you have more, let's call it, of a stable income that the banks like to see, as opposed to just running your sole proprietor, I think like Evan's talking about, and just kind of making chunks of money here and there. I know that, or I feel at least, that banks would rather see a steady income
From a company.
From a company, you being a corporation, paying yourself as a employee in that company with a stable income, as opposed to just chunks coming here or there. Let's say both those situations, you net out the same at the end of the year. Is there a preference on how the bank looks at that? Is that what you're asking?
Yes.
All right.
Thank you.
You're welcome.
I don't know. I just couldn't get that out.
Yeah. No.
So to clarify, I can't
yeah.
speak for bricks and mortar banks.
Okay.
I can speak for the broker channel. So yes, we do represent TD. We do represent Scotia. And in some parts of the country, we represent BMO as far as banks are concerned. But we also we represent 32 different mortgage lenders. So based on that, here's the answer. If you're incorporated or you're a sole proprietorship, we don't care. As long as you declare your income and you have tax returns to back up that income that you're declaring. Why would you go to an incorporation as opposed to a sole proprietorship? The number one reason is taxes.
I know things were
You're going to be taxed lower as an incorporated company because you're taking money out either A, as an employee, or B, as a dividend.
Yeah.
So there is a certain point where if you're making, say, $150,000 or over $150,000, it's to your advantage to become incorporated. If you're making less than $150,000, claiming a less than $150,000, it's probably best to be sole proprietor. That number
were
changes.
simpler when we were sole proprietor. I feel like I don't know what I'm doing.
Well, probably because you just have multiple accounts now too.
Yeah.
Right. But
so that's the clearest and simplest way to put it, right?
okay,
Cool.
so
Well,
as long as the same amount of income is being declared, what I'm hearing is it doesn't matter whether you're incorporated or sole proprietor.
As long as you're claiming your taxes.
Now that's interesting. Okay, that's a little bit contrary to what I believed, but that could just be something,
I
you
really
hear
had
something
my
once.
tongue twisted there.
So here's what we look for in sole proprietorship versus incorporated.
Yep.
We look for a history, right? We want to see 2 years history, your T1 tax returns, that's your tax return, your notice of assessment for 2 years. We probably want to see some background on how you're getting your money. In other words, if you have an accountant statement.
Right.
If you're incorporated, we need all of that, plus we need your corporate tax return. Because we can use your corporate tax return to actually increase your income because you might have appreciatory value in your company.
Right.
So
because there's your income and then the company's income as well.
Right. So maybe
it's two entities.
Yeah. So maybe you've got computers and you've got computers and lights and
All
cameras.
assets and maybe a building.
That's an asset that we can actually use a portion of to increase your income.
Okay, good to know. So then that's on what is income. Let's talk about down payments for a minute.
Yes.
So if somebody is looking to make a down payment, let's start off on the residential home, but let's open the conversation up to putting down payments on duplex, triplex, and 4 and above, pretty well commercials. So let's start off at the residential, putting down payments. First of all, what can be considered a down payment?
So
where can a down payment come from?
Down payment can come from your RSP, from your first-time home buyer's plan. It can come from your savings account. Could be from the sale of an asset. If you have a car in the backyard or a second car and you don't need it, and you sell that car and you have a receipt with the name of the person that bought it and the phone number of that person that bought it, and you can provide that, you dump that money into your bank account. That's your down payment.
I guess that's
Do you
a
need
broad
that
question.
before? Do you need that before the pre-approval?
Because the money has
Is that part of the pre-approval?
No, but you intend to do this.
But you intend to do this prior to the closing of the property?
Yes.
Okay.
So usually 10 days, 15 days before close. Car, bike, trike, side-by-side, boat. I have had clients sell playing cards on the internet.
Playing cards.
Sports cards and stuff, man. They're worth a ton.
Sports cards.
Well, they are, some of them.
Well, the right ones.
Internet cards, magic cards. they call
Pokemon
them.
cards.
I've had a client.
You got a Charizard? You're good to go. You're getting a mansion.
$25,000 down payment from the sale of playing cards because he had all the receipts.
What's the rule with crypto?
Crypto is.
Do you ever have clients that say, I got it in crypto?
We need to see every sale and purchase and every receipt from every transaction on a crypto.
Which
Good
normally
luck.
people are pulling in and out a lot and doing like day trading on there.
It can be done, but it's super, super difficult.
So that's a pretty, I guess, for more simpler terms, the down payment aspect, I guess that's a pretty broad question, and depending on what you're getting a down payment for, is it your second property, third property, or is it your first one, right? Because you can pull the down payment out of a property to get another one
if you want to refinance.
If you want to refi that property,
Right.
But I think, are you wondering, Brandon, for a first house, right?
Don't forget.
No.
Or all in general?
No, yeah, I was opening the whole conversation
Okay.
up to
whatever.
to talk about down payments from the perspective of your first home per se, or if you were
Which is-
selling your house and then putting a down payment on another one, and then actually going into the investment property aspect of it too.
So 5%, right, is for your first home. Now, if
Right.
I buy a second property, it's not going to be 5, is it?
Wrong.
Okay.
This is where I want to have the conversation.
So
right?
I'm gonna finish up the down payment, where the down payments come from. We
Yes,
talked about it. So you
perfect.
can get it from not cash, but you can get it from your savings account. Get it from your TFSA. You can get it from your RRSP. You can have it as a gift from a family member.
Right.
Right. A gift from a family member.
gift
It has to be
letter.
a gift, not a loan.
No, not a loan, but a gift from a family member. The family member deposits the money into your bank account.
Not a loan.
We send a gift letter to the family member. They fill it out. They sign it. The client signs it, and that's the gifted down payment. Now, let's go back to the down payment portion. 5% for a single family home, that's a minimum.
Which is crazy. Because in the States, they do it cheaper in some spots. You can do friggin' 2-3% down in the States.
But we have
Now-
something they don't have in the States, which is you can do something called a flex down, which means if you have very little debt and you are buying a house, you can borrow money on your line of credit for your down payment.
Yeah,
Oh, really?
And then,
Yes.
so, okay.
Wait, we have that?
We have that.
Well, yeah, I've done
I
that
didn't think
before.
you could. Okay.
I've done that before.
You've done that before.
Yeah,
eh?
you can use that. But and then what I did, I don't know if it's whatever. It depends on who's doing it. Say you borrow 30,000 to put down on a house, then what I do is I just borrow the extra money on the mortgage to pay my line of credit off.
Mm-hmm.
Put it all under one tree.
Yep, that's the way you want to do it. But you can borrow money from your existing line of credit, but we have to add that debt to your debt line.
Right. So as long as you're
as long as you still qualify.
as long as your ratio's
Well, this
still
is
good
what
at
all
that
these-
point.
Yes.
Okay.
This is
Okay.
what all these, like, we met people when we went to Vegas. There was one guy I met, no joke, he was like 30 million in debt from properties. He's like, Evan, I don't have any money sitting in my bank. Yeah, it's nice if you have 2, 3, 400,000, 50,000, whatever. It's nice to look at, but it's not doing anything. So
But he's cash flowing.
it's
from
cash
these
flowing. He's
properties,
rich.
though?
He's got Lambos. He's got this and that, but he's all debt. He's cash flowing every month, but he's not showing any. They just keep pulling line of credits out, using their line of credits and their equity to buy other properties. It's pretty interesting.
And I think what you're kind of talking about too is almost like the Grant Cardone method of like pretty well having most of your money tied up in real estate that's cash flowing
it's pretty wild how
to
you
pay
can,
off the debt so that you have more income coming in than your debt ratio kind of deal. So it's like you'll have a lot of debt, let's say the $30 million of debt, but there's X amount of income that then balances this whole thing out and makes it worthwhile to service and have that debt. Is that
Yeah,
what we're
like-
talking about?
we could do a
Yeah.
whole podcast
On
just on
this.
just on the best way to invest in multiple properties in Canada. Let's not get
All right.
waylaid by the U.S.
Well, we got lots
Yeah.
of time. Luckily,
well, we got a little bit of time here. I
No,
want to
like
touch on.
I mean, not today, but like we'll be able to do this in the future
Yeah.
too.
Yeah.
That's a
Yeah.
great episode
Because
coming
we
up.
have more-
Stay tuned, everybody.
No,
We have
that'll
more-
be that's an interesting one. That's for investors and things because that's such a fun topic because
Yeah.
like I had people like I telling me when I sold one of my houses and I was like looking for I'll just say this real quick, looking for somewhere to rent while we were building this place, and I went and looked at I was like no, I'm not paying somebody this. I called the bank. I was like, listen, there's a duplex down here. I want to buy it. It's basically a shithole. So I went while I was selling my house, pulled money out of my house, bought this house, borrowed 40,000 on the other house to do the renos, fixed that one up, borrowed money again to do this one, and it was just moving money around. And I was like, whatever, sold it all, and that's how that's essentially it. Just all worked out and was able to build the house.
The biggest trend that we've found in southern New Brunswick is young couples looking for multi-units so that they can move on to the next house.
Yeah.
So there is a growing, and I mean a growing part of our market that is looking for that
Investments.
first house in looking for their second house, looking for their third property.
Yeah.
So
Yeah.
there is a growing entrepreneurial spirit as we
Right.
talked about, looking for multiple units. So yes, that's something we could definitely spend a whole hour talking about.
Yeah.
The ins and
Okay.
outs, the pluses and minuses.
Should we talk about how much a deposit can be for those, or do you want to skip over that right now and kind of move on to
Well, we're going back to the purchase and sale agreement. In other words, what the client needs to do.
Yes. Okay.
Okay. So we've already talked a little bit about, and we did talk about 5% as a minimum down payment for a single family house. So I think we kind of have to stay in that lane, because if we get into duplexes, again, 5%. But once it's a triplex or a quad, then
so
it's
a duplex can be 5, even if it's your second property.
Even if it's your second property,
you have to live in the duplex?
Planning on living on it.
You have to plan on living
in
there.
You have to live in it.
Yes.
Right. So you need to be the primary owner.
Under the second home program, you have to live in that property.
So if you don't live in it, it's
20%.
20?
Yeah.
For everybody, every
Any
lender.
investment property is 20%.
Why?
Because you're not living in it, and them's the rules.
Right.
What does that have to do with anything? Live in it or don't live in it, or have a cat there? Who cares?
Right.
Why does that matter?
Because if you're making money, everybody else wants a piece of it.
It just doesn't make sense. No, does it? It doesn't make sense. Why 20? You don't know.
I have no idea.
It's so bizarre.
I'm sure if Brad made the rules, he'd be able to.
Let me ask you this. Okay, say I put 20% down on a second property, and we're like, okay, Brad, here's what we're going to do. I'm going to put 20% down. I'm going to buy this place. We're going to leave it open, and once it closes, then I'm going to remortgage it, and we're going to lock it in. I'm going to pull my money back out. Can you do that?
Lenders will have a real hard time with why are you switching and why are you flipping it so quickly?
No. I want to keep it.
Yeah.
What I would say is, we're going to do this. I'm going to leave it as an open mortgage, whatever, until it closes. Okay. After it closes, I'm going to bring an appraiser in. I might do a thing or two to it, and then I want my money back, my 15% extra that I put into it. Then we're going to lock it in for 5 years after I get my equity out to get my money back. That's
an interesting scenario. It's possible, yeah. It's possible. I'd have to look at all that.
One, you know what I mean?
There's say
you're putting, you need 20% down. It's $80,000.
But
yes.
But I'm like, I want this cash flow. I don't want to tie it on. So say, Brad, don't lock this mortgage in. We'll leave it open. After it closes, I'm going to bring the appraiser in and see if we can get this thing appraised for more. Maybe I have to put a new bathroom in it, whatever. But I want at least $70,000 back. Then we're going to lock it in for 5 years. Is that possible?
I would say that you're not in control of that in regards to the appraiser part of it.
Right. No.
I would say that if you got it as an open and then you decided to transfer it or switch it over to another bank or refinance it to another bank, then the bank would probably call for an appraisal.
Yeah.
And then yes, it is possible to go from an open to another.
To get money back.
Yeah. I mean, if you believe that the property's been improved in value,
right?
If the property's worth more than you originally paid for it, you open it up as an open. Again, it depends if the underwriters will buy into it, but it makes more sense if you are improving the property.
Because I think that's what people do, right? To get their equity.
I think they do it, but they do it over a longer period of time.
The Burr.
I'm like, I want to buy.
What you're talking about, buy, refurbish, refinance. Is that kind of what you're thinking?
And because people use
heard that.
Again, if you wanted to use that, what I'm saying is, if you bought a property with your line of credit and you wanted that money back somehow, to pay it off,
right?
We're getting into investments again.
Okay, sorry.
I'm going to bring it back. So
this is the ADHD of Brandon and Evan Young's podcast.
Squirrel.
Yeah.
So client, we've done the pre-approval. We've gotten the information. We've gotten their income documents. We've gotten their credit check pulled.
Yes.
We underwrite the file. We then contact the realtor and say,
underwrite the file. Can we touch on that real quick?
We look at everything that the underwriter looks at. We pre-underwrite it.
Let's just explain what the underwriter is to everybody, because that's a strange term I think that most people don't understand. I think even us in real estate, I've never seen this underwriter. I've never seen what one looks like.
He's like the Undertaker in the
It's like a mythical creature. I picture the underwriters.
Sometimes
I picture a bunch of people in suits in a smoky cigar room with briefcases that they open up once a week, and they all go right, and they go, yes, no, yes, no, yes.
And it's crazy.
No.
And it depends on these guys too. They have relationships with some of these.
Right.
It is Underwriter Appreciation Week, by the way.
Is it Underwriter Appreciation Week? Well, wicked.
There you go.
I would love to meet some of these underwriters.
Bring them a box of cigars.
I would love to meet them.
So,
if there's any underwriters out there, we'd love to have you on.
We anticipate what the bank's underwriters are going to look at in the application to make sure it meets all of the criteria of the Lending Act. So that's what an underwriter does. We have to tick off all of the boxes. If there's any red flags on the deal, we're going to pick them up first before the underwriter picks it up at the bank.
So you're explaining what you do, but the underwriter, so they oversee the file that you put together, the proposal. So pretty well the way that I see it is you will put a proposal together that you then send to the underwriter. So you're making the most favorable file and the most favorable case possible for the client, saying here's the reason that they should be approved.
Right. They've met this criteria, this criteria, this criteria. And we also have a storyline, which we expound very well on about, Joe had a bit of a problem when he was out west and he may have missed some payments. Then he broke his leg and then he had to be hospitalized, like all of that background, right?
And all that matters. And that's what I'm trying to, I guess,
it does
make
matter.
Important here and make known is that it doesn't just start and stop with you approving it, that there's an underwriter involved, and the story and the way that you present the file to the underwriter matters, which is why it really matters who you pick to help get you the mortgage, because you want to pick somebody that's going to make a favorable story and scenario and know how to work the underwriter, because that's a whole other aspect of getting a mortgage that I think most people don't even know about.
Right. And the underwriters really are there.
They can kill it. They're the ones who's making the final say, basically.
Well,
Right.
it could be them, and it could be the insurer, whether it's CMHC or Sagen or Canada Guarantee. If you're putting 5% down, remember the underwriter at the bank or the lender has got to approve it. Then they take it to the insurer, and the insurer has the final say.
So when's this? So
It all happens within 4 hours.
the underwriter and the CMHC both look at it.
Yes. Well, the underwriter sees it, then they move
So
it to
they kind of double check everything.
So the underwriter basically is trying to confirm everything that I've said, right? And if they agree with it, that's great. The bank has approved it. They take it to the insurer.
Then the insurer at that point.
The insurer, because they are, monitoring. They're the overseers of all insured mortgages in
And
the
in
country.
this case, it's CMHC pretty well, has the monopoly there, right?
Well, it's CMHC, Sagen, and Canada Guarantee. They're 3 different companies.
It's a
2 of them are
it's a
private. One of them
triopoly
is
then.
government.
Okay.
But they all answer to the same. They all answer to the same overlord of the federal government. So at the end of the day,
Overlord.
they're the ones that have to be culpable for any audits. So yes, absolutely, we underwrite the file, or we pre-underwrite the file and give a letter of pre-approval to you, the realtor. That tells the realtor, hey, listen, this client is good to go. It gives you the confidence that your client is ready to go. They have the down payment. They've met all the criteria. You include it in the purchase and sale when you make an offer on a house. That gives the seller of the house confidence that your client
100%, especially
It's
in
ready to
this
go.
market today. Like,
Right.
That's one thing. So basically, before anyone looks at a property, call your bank or broker or whoever you're working with to get all your ducks in a row, and then you could start shopping. Because a lot of people, I feel like, over the years of doing this, a lot of people go online and do this pre-approval. Oh, I'm approved for 500, but no, you're
That's
not
the worst.
really. You might be approved only for 3. So you're only doing yourself a favor, because you could be setting high expectations for yourself and letting yourself down. So if you talk to Brad or whoever's doing it first, you know what you can get and what you can't get, and then everything's done. And in a competitive market like we have today here in New Brunswick, when that's all your ducks are in a row, we can get things done in like 5 days.
We can
or
tell
less.
the client what
Right.
their budget is. We can tell the client what it looks like. And what property taxes play a big part of debt too. So we break it down: property tax and mortgage. We tell the client, hey, you're good to this point. This is what your basic maximum budget is. I will tell you that if you go online, 99.9% of those online websites that say you're pre-approved, it's bullshit.
100%.
Yeah.
It's not pre-approved, you're pre-qualified. What
Right.
that means is your income, you're stating your debt. The algorithm says, yep, you're qualified for this amount of money. It doesn't take into effect that you might be paying alimony, child support. You might have a lien on your house. You might have a lien on your truck. You might have all of these little caveats.
That's not land
And
taxes,
it's
house
only
insurance.
as accurate as you're being to the system too, right? So a lot of people probably fudge it a little bit, like, oh, I make X amount of dollars, and it's not the exact. Like, everybody plays their situation up
Right.
a little bit when they don't have to show proof.
Pre-qualified is not pre-approved. Pre-qualified is not pre-approved. That's
Right.
all I will tell anybody.
Exactly.
No, it's
Yep.
true. I'm glad we touched on that. So it's pretty simple, really. If you're looking to buy a house, go to the bank or broker or whoever. Brad is available, taking applications. But seriously though, to go, you got to go talk to any bank or broker,
go to
anything
your bank,
first.
your broker, your credit union.
Get the pre-approval done.
Get the pre-approval done.
Get it done.
Absolutely.
So
Because
I actually won't take anyone out until they do that now.
Well, exactly.
I just won't. No offense to anybody, but like,
I'll go meet them the first time, and then if they haven't done it, they have to do that, right?
yes, get the questions and help them, because some people just don't know where to go or what to do or who would be the best fit for them.
Yeah.
And it's less even about us, and it's more about the client's time too. So if you're not going to go and get pre-approved, they're wasting their own time, because if they find a property, they get all excited, they put an offer in and find out that they don't actually have the finances to be able to
can't even compete now.
to get financing on this property, then everything was a waste of time. It's a huge burden on your emotions, and it's just not good for anybody.
But you say that, so sometimes it take like what you need, Brad, for a pre-approval. You need a lot of documents, T4s, any. There's a lot of stuff a bank needs to get the pre-approval done, and sometimes that can take people 3, 4, 5 days around all this stuff up.
Absolutely,
so if you're going to look at a house and you want a realtor to write an offer on it for you,
you need to be ready.
You're not even going to stand a chance in this market, because you're going to have to put 2 weeks for conditions, right?
Exactly. So when you make your offer to the seller and say you get approved, now the clock starts ticking.
Yes.
You've got 5 days, 6 days, 10 days to get your financing together, meaning we've got to send the application to the lender and get approved. And then once we have an approval, because we have all your documents, we'll send a letter of finance out to your realtor, and everybody knows that it's done. You've got that same amount of time to get your minimum 5% deposit to your realtor, or to your realtor's lawyer, or to the seller's realtor.
Right.
So you've got, the clock starts ticking. So if you've got 5 days to finance or 10 days to finance,
all your conditions on there.
Right. So let's talk a little bit about that. So
Yes.
there's always conditions on the purchase and sale agreement: water test, maybe
Inspections, insurance, if there's any work that needs to be done prior to firming the deal up. And we say firm, meaning that the deposit has been given and all conditions have been met.
Right.
Yeah.
So in the past, we've always had to kind of chase realtors for things like water test, insurance, that kind of thing. As of last year, or most recently, most lenders are asking for us to make sure that once the conditions are met, we get a waiver of conditions.
Okay, is that what they're asking for now?
Yeah, they're asking for a waiver of conditions. That
The
way,
fulfillment.
Because
fulfillment,
I've been asked,
whatever.
fulfillment
I've been
of
asked
conditions.
for that
way,
form, yeah.
We're not chasing, and the lawyer at the end of the deal is not chasing for all these little things. So once we have a fulfillment of conditions, that means water's kind of past the deal, got the insurance in place, blah, blah, blah.
inspection. Yep.
Right. So you've got that period to get your deposit in. You've got to get your financing done. You got to get your inspection and water test and all that time. Once that's done, the majority of the work is done.
Yeah. And a
Now-
lot of this, I find one of the things that takes the longest for most deals is the financing, is your part. And it's either people don't have their ducks in a row, or they're working with a bank that's slow, or it seems like everything happens at the 11th hour. It seems like it always happens at the 11th hour, but I've heard and done deals with you before where it's quick, where it's quicker.
But it's also we just talked about this a couple days ago. You need to be surrounded by the right people, like professionally wise.
Yep.
The right realtor, the right banker, broker. You need to be surrounded by the right people. When the offer is accepted for me, I'm like, let's go. If something goes wrong, something goes wrong. If a water test doesn't pass and your conditions are only 5 days, like,
Shock the well and move on.
no big deal.
You
We
can always
just
fix a water
signed an
test.
amendment that the water will be fixed by closing. No big deal. But if you're around the wrong people, like if you have one realtor and one's always trying to butt heads with another, they can, honest to God, wreck a deal over a water test or something so ridiculous instead of working together.
I
right?
would say it all starts with the realtor. If
100%.
I have realtor number A, say the realtor number A is Evan, and he comes to me with a client. He says a client is looking to buy a house. I'm on the phone with that client within an hour. That client within that hour knows what documents they have to us within 24 hours or as soon as they possibly can. There are initial documents we need right away. We can get the rest of the documents later. Letter of employment, we can get that later.
Yeah.
If you tell me you don't owe the tax man money, well, we can get that notice of assessment later, as long as you tell me the truth.
Right.
So we can get that pre-application done the same day. right? So it starts with the realtor. If you have realtor B who says, I have a client and here's their phone number, and we try to get a hold of them and say the realtor's not done their homework with the client or hasn't got established a relationship with the client. Now the client takes a week, 2 weeks, 3 weeks to get their documents to us, but yet they've gone out and they put an offer on a property because the realtor didn't tell them you got to have your documents up front, you got to get your financing in place.
Yep.
That can be a nightmare.
And not only that, actually, you can lose. It's if you don't do your homework. And in today, if I have 10 offers on a property and somebody's telling me, oh yeah, my guy's good, I'm taking your word for it, Brandon, because I trust you. You're professional, you know what you're doing. And then you call me in 6 days and oh, sorry, yeah, I didn't good. I'm like,
Couldn't
man,
get financing.
What do you mean? You swore to me that everything was good.
And it's going to make you second guess that
Next time.
Absolutely.
Right?
Yeah. So even the relationship and the reputation matters significantly as well when doing business. And I mean, not that it should.
And that's with everybody. That's not just realtors.
I mean, but it's yeah, exactly. That's just a life thing, right? So it's like the better the reputation, and the more you're known for, let's say, qualifying the clients, then
like Brad, you call Brad, you're getting it done.
Then the better that's going to be.
Whether it's a no or yes, you're getting it done.
Right?
Yeah.
Right?
You're in this industry, we all are only as good as our last deal.
100%.
Yeah.
Right.
I think that's a good way to bring it back around and wrap things up, eh?
Yep.
That was a really good chat. I enjoyed that.
Did we make it to the end
Did we?
of the buying process? Pretty well. I mean, we're close. So
Once you've met your conditions, you're going to the lawyer.
Oh, yes.
The lawyer's going to close about a week before the house closes. You're going to meet your lawyer.
Yes.
He's
Let's
going to
just
do
wrap
all
that
the
up.
accounting.
Oh, yes.
He's going to do all the legal work. We can have another discussion about the ins and outs of closing costs, and maybe we'll bring a lawyer in to talk about it.
That would
that'd
be
be
cool.
cool.
Let's bring
That'd be
Fred
really
over.
good.
We'll bring Fred over and we'll have
Yeah.
a little chat.
And
But on the lawyer, so I just had to chat with somebody yesterday. If you guys have a lawyer or any clients have a lawyer, that's great. Just give us a name. But if not, we can find one for you. And you don't need to do anything. We get everything sent to the lawyer for you. So you literally just show up. So that's some people think of a lawyer and they get a little bit scared, eh? Like, what do I need a lawyer for? And this, no. You need it to get the property into your name and a few other things, but we look after all of that.
And
sending all the paperwork from the mortgage stuff
Yeah.
to the everything. We get everything sent to the lawyer.
So your realtor or your broker can actually suggest 3 different lawyers.
Right.
But the point is that the lawyer needs to be advised before the file is coming to them that they're representing the client.
Of course.
So they need time to prepare the instructions to get it done. Yeah.
So stay
and then
tuned
the
for
mortgage
that.
instructions then get sent to the lawyer,
Yes.
and that instructs them how to process everything so that the title search and all of that stuff happens.
And the province gets their land their land tax,
get
and
their
they
lands, the
yeah.
1%.
Which is crazy.
Yeah.
$1
1%,
on every 1,000, right? Or
I think it's a percent. So it
works out to $1 on every 1,000. Like if a property's 250,000, it's $2,500 for land transfer
So
tax.
what I tell clients is this: it's going to be different depending on who you have as your lawyer. Some lawyers are more expensive than others, but at the end of the day,
lawyer fees.
I always say minimum down payment's 5%. Expect that your closing costs will be somewhere between 2.5 and 3% of the purchase price.
Yeah, it's true.
Those
Yeah.
the land transfer tax
that's
is does every
because the
province
land-
do that?
Yes, and it's
Because
a different
1%
amount.
of that is the land transfer tax. 1% right off the bat.
1% of land
Yes.
transfer tax, you got to pay your property taxes for the rest of the year because your sellers
Yes.
already paid their property taxes. So you got to reimburse them that. You got to put land transfer tax. You've got the AFR registration. So there are, and then
That's time to
And then
buy.
that's before your lawyer fees, right?
and that's
These are all
then you've got your
standard.
cost of your lawyer, admin,
Right.
and HST. Yeah.
Right.
The best time to actually buy a property is probably like November because you're not paying that much in taxes.
Depending if you are paying your own taxes the following year, or depending if you have the bank picking up your taxes.
Right.
Because if the bank picks up your taxes in November, and here we're going down the rabbit hole here, kids. But
Hang on.
But if you buy a house in November and you only have to pay back the seller for 1 month, that's
Yeah.
great.
Yeah.
But if your bank is taking your property taxes towards 2025's taxes, they're going to ask you for 2/3 of next year's taxes up front, and they're going to ask the lawyer to collect that. And then the next month, they're going to grab a month's worth of property taxes.
But then is that a credit for you coming
Yes.
into that year, though?
Yeah.
Because then you don't need to pay that? Or
Well, your property taxes are due in June, so The lender has a property tax account that they've taken 2/3 from you at closing.
Yeah.
So it's an additional 2/3 to your 2.5 or 3%.
Right.
Plus every month they're taking out a month's payment to put into that property tax account. It has to be whole by June 1st.
8% basically is what you need to buy a house. 8% saved up,
Depending
or
on the
some
time of the
sort
year.
of money.
If it's
7, 8.
If it's the first quarter of the year, I always say 8%. If it's halfway through the year, it's about 2.75%, and if it's in the last quarter of the year, it's about 2.5%. That's the average.
It went from 8% to 2.5%?
No. You
No,
mean
I'm talking about the closing costs. So
Closing
Yeah.
costs. Yeah,
closing
yeah.
costs can range between 2.5% and 3%, depending on
Right.
the time of the year.
2.5% and 3%. Okay.
I
Depending on
just
the time
tell
of the year
everybody
that you
have
buy.
7,
Yes.
8%, and you'll be good.
Yeah,
Expect to spend that.
Yeah.
exactly. And then
Yeah.
you'll be
Expect to
happily surprised when you have money left over.
But
Exactly,
Stay
yeah.
tuned, because we're gonna do that. We're gonna set that up. We're gonna bring a lawyer on, and we'll really get, because a lot of people want to know exactly where the money's going, what it does. So let's bring on a lawyer, because this is what the people are gonna want. So we're gonna give what the people want.
All right. We'll have to open up our wallets to get a lawyer on here.
No.
I'm just joking.
Yeah.
I'll pay him.
I'll
Yeah.
pay him. All right. There
I'll
we
pay
go.
him.
Yeah.
All right.
No, we're gonna do that. We'll do that. We have
Sweet. Yeah, so then that kind of wraps it up in a bow. So I'm hoping now, after this conversation, for those that are still watching, we'll have a much better idea on the entire process, from going to get pre-approved to then closing the deal. So that's pretty well what we just covered and
think we-
tied up with a bow here.
I think
So-
we broke it
and
down
then-
pretty good.
Yeah, no, absolutely. And I mean, we had a couple really good
Side
tangents
tracks.
that were much needed. And then I think there's probably a whole other episode on investing that we could talk about.
Yeah, that's a good one. Yeah. A lot of people are into investing. I think that would, there's a lot of people looking to invest in New Brunswick. So that would be a good one
And
to
like
talk
you said,
on.
a lot more people have that entrepreneurial spirit and are kind of looking at that as an avenue. And I think it's also because the internet makes it much easier and explains everything easier now.
Yeah.
For people, there's much more, information. Anyway, let's wrap this up. Brad, thank you
was
so
a
much.
pleasure.
That was really good.
Thanks, guys.
And till next time.